Hello again, everyone. It's Vince Four from TradingWinds.com, and this is our update for May the 1st, 2024. Well, it was a quiet start, but a wild finish to the first trading session in May. Let's have a look at the numbers. The Dow finished higher by 99 points here, but it was up well over 400 points after the Fed's decision on interest rates, and more importantly, Fed Chair Powell's comments in the conference call after the announcement. So the Fed decided to hold rates steady as expected. Um, they did reduce their quantitative easing or tightening, sorry, from 60 billion down to I believe it was 35 billion, or to 25 billion, I believe. They've dropped it 35 billion. So that was bullish, and I expected the market to react from that. But really, what the market jumped on was Chairman Powell's comment about, I think his words were something along the lines of the next move, or no, sorry, he said something along the lines of that we're unlikely to see the next move be a hike. In other words, he's expecting the next move to be a rate cut. Market loved it. Market went screaming higher. But then gave it all back. Let me show you the S&P 500 here, which finished lower by about 17 points. But what I want you to have a look at is the 5-minute chart. So right down here is where the Fed's announcement was, or on this bar here. So we moved up slightly, came back, kind of went quiet. Then the conference call started. And when he made that comment, boom, everything just took off, right? We went from like where were we here? Down about 50.62 up to a high of 51.26. And then have a look at the last half hour. We just gave it all right back. So similar to yesterday, sellers stepped up big time in the last half hour here and pushed stocks all the way back down. So we ended up mixed. The NASDAQ also down 117, same pattern, went screaming higher, gave it all back. The Russell finished higher by 10 points. So Dow and Russell slightly higher, while the S&P and the Nasdaq finished slightly lower, but gave back all those gains. So an interesting day overall, and this tends to happen. I've mentioned this in the past that when we get to a transition period, when you start going from bullish to bearish, you start to see these gains whenever the market gets excited and sees gains. They don't last for very long. So that is a sign of weakness in the market. So this is normal behavior, in my opinion, if we are in fact transitioning from a bull market to a bear market. And, when you look at the Dow or the S&P 500 or the NASDAQ, et cetera, what you see is the daily and the weekly, which have already rolled, the monthly not yet, right? And so here on the NASDAQ, same thing. So we have 2 out of the 3 time frames aligned. If the monthly gives way, then we know we're in a solid downtrend. Having a look at crude oil here, it had a significantly bearish day. We not only cleared this low, we did so with authority here. I mean, it flushed into the close, down almost, down over 3% here on the day, and finishing near the low of the day, while gold made back some ground here, up almost 26 points on the day. Helping gold do that was the dollar, which gave back gains here. So finishing at 105.58. We were at 106 this morning when we had our chat. So again, what we saw is the Fed hint again that we should not see any rate hikes, which the market loved, but did say that they continue to monitor the inflation numbers, and really we shouldn't expect a rate cut soon, but later this year. So that's where we're at with the markets. And volatility right now has stepped back in. It should continue as we see earnings from the likes of Apple tomorrow after the market close. Apple finishing back below the 20 here today, and then of course the full employment report on Friday morning before the market opens. So again, expect more volatility here. Tread lightly as we transition. Um, sorry, I shouldn't say transition. I should say as we're in that in between spot where we really don't have a clear uptrend, nor do we have a clear downtrend in the markets right now. So let's tread lightly. Now,